Welcome back. The demand for a rate cut has resurfaced, and this time the triggers are the latest retail inflation and industrial production numbers. Retail inflation has witnessed a sharp slowdown in June, coming in at 1.54%. This is food inflation contracted for the second consecutive time. Now, if you look at the May industrial output numbers, they've come in at 1.7%, indicating a slowdown in growth across 8 core industries. In this backdrop, the big question is, should the Reserve Bank cut rates now? Chief Economic Advisor Arvind Virmani believes it should. Speaking to the media after the CPI and IIP reports last evening, the Chief Economic Advisor said, and I quote, "This low number and what it implies about underlying price pressures, as well as the latest data on the IIP, is something that I'm sure all policymakers will reflect upon very carefully." To discuss the Chief Economic Advisor's statement, the clamour in North Block for a rate cut and what the MPC should do, I'm joined now by the former Chief Economic Advisors Arvind Virmani and Professor at the Indian Council for Research in International Economic Relations, also the former Chief Economic Advisor Dr. Shankar Acharya. Gentlemen, appreciate you joining us here on the show. Dr. Acharya, let me start by asking you to comment on the statement that's come in from the Chief Economic Advisor Arvind Virmani, and this is his second public statement stating that the MPC needs to cut rates. The government's point of view is very clear. The rate cut should have happened in the last policy. It didn't happen then, but given the kind of numbers that we're looking at, there is absolutely no room for the MPC not to cut rates. Would you agree?
I think I have a lot of sympathy for that view, and I think articulated that on your channel a month ago in some little bite, that even last time in early June that I was looking for some reduction in the policy rate, given that inflation rate had clearly come down, very comfortable range, and also that all the indicators, including the IIP and various other indicators, showed that the economy was not only sluggish but getting sluggish month after month. So there seemed to be, as good a case as you can have for some policy rate reduction. It didn't happen, and now I think the data that's come out in the last couple of days on the CPI, on the IIP, and one or two other factors suggests that it's a stronger case. So I have full sympathy for the CEA's view. It's another matter, by the way, in my view, whether disagreements between the Finance Ministry and the Reserve Bank should be so publicly debated, but that's a different issue.
So let me pick up on that point, Dr. Acharya. You're saying that you have sympathy for the Chief Economic Advisor's point of view when it comes to a rate cut, but the manner in which this view is being expressed, this public friction that we seem to be seeing, and this is the second time that the CEA has gone public with his call and his demand for a rate cut. Is this healthy? Is this good news from an autonomy point of view as far as the RBI is concerned?
Let me put it differently. In my answer, let's say that in all the period that I was associated with government, and I think even up to something like 2008 or so, if one was a reader of newspapers, one generally didn't find public statements either from the upper reaches of the central bank or from the upper reaches of the Finance Ministry in which strong differences were aired on monetary policy issues, or for that matter, exchange rate policy issues. And I think that tradition I was personally much more comfortable with, I guess because I'm an old-timer. And I think that's kind of disappeared post-2008 more and more. And I think that's a pity, because I think what really matters is not what is said publicly, but what is said to each other in a manner which is constructive, critically constructive if necessary, and cooperative. And then what is loosely called authorities on this matter, which is a combination of the central bank and the Finance Ministry, line up behind an agreed policy change.
Okay, so let me take that now to the former Chief Economic Advisor as well, Arvind Virmani. Mr. Virmani, before I ask you about rate cuts, let me ask you about what we just heard there from Shankar Acharya. He says he's an old-timer, so he doesn't believe that strong differences between North Block and Mint Street should be expressed publicly, and we've started to see that happen post-2008, and that is a pity. Would you agree?
So the way I looked at it during my tenure is to separate out the technical issues from the decision on policies. What do I mean by technical issues? There was areas in which I differed, so I actually started a paper series where we analyzed the issues of capital flows and other things which were contentious in a kind of semi-academic and analytical manner given the data. So I think it's perfectly legitimate to be able to put forth an analysis, but I think it's better done through some kind of a paper or a note rather than through TV. And so I think that kind of analysis and debate based on analysis is good and healthy. What I also, where I agree with Shankar is that I'm not sure this public discussion, especially on the electronic media, on specific policies pursued by the central bank is healthy, because, well, it's not a question of healthy, it just gives rise to, it changes the focus. Unfortunately, it's a fact of life that it changes the focus to the conflict, so-called, between the government and the RBI rather than on the issues which need to be discussed. So, so I have this kind of dual view in a way, yeah.
Okay, dual view, but you're also in the old-timer camp like Dr. Shankar Acharya. But Mr. Virmani, let me ask you then about the possibility of a rate cut now. And yes, now the street is talking about a 70% possibility of a rate cut in the August policy when the MPC does meet. What are you working with at this point in time, given the data that's on the table?
So first the analysis. You know, currently our real repo rate is probably among the highest, if not the highest in the world, at 4.75%. That is the repo rate minus the current inflation rate. Now that's one point. The second point is, for the first time since the inflation targeting was adopted, the rate is outside the mandate. The mandate was for 4% CPI inflation and a plus minus 2% margin of error, which is given basically because there could be errors in forecasting ahead, and there could be errors in transmission. Now that has been violated, and I think one should take that violation more seriously than perhaps the attention or the stuff I have read so far in any case. That's the second point. The third point is that again, I said this after the February and April meetings, that they kind of bound themselves into a corner by being very assertive and really taking measures which were tightening. So the question is, can they get out of this bind? Well, if they don't want to, it could be said that this is a bottom. So you won't see 1.5, it will probably rise from here on in, and they could again postpone the decision of raising the interest rate by claiming that it's moving back towards, you know, I think they made it very flexible, 2 to 3.5%. I think it'll be more closer to the bottom of their edge, and I would not be surprised if they again postpone the decision.
Okay, you're saying you wouldn't be surprised if they again postpone the decision, but Dr. Shankar Acharya, let me ask you, because you're betting on the fact that there is going to be a rate cut in the next policy meeting. Now, if indeed it is a 25 basis point cut, sir, is that really going to make a meaningful difference on the ground when we talk about demand and credit and investment picking up?
Let me first say that, you know, whether my own personal view, it was that in, I think, June as well, was anything between 25 and 50 would have been a reasonable thing to do then. Now, assuming we are in a data-dependent policy framework, now we have data which suggests that inflation is coming down faster, and possibly, you know, the real economy is slowing faster. So I think I would certainly have liked to see going forward, a rate cut of in the order of 50 basis points. Now, how much of an effect it will have is an debatable issue, because we do have the structural problems, including the whole twin debt, twin balance sheet problems and so forth. But that doesn't mean that I think monetary policy should be completely static.
Okay, but Mr. Virmani, let me ask you this. What are the levers the government can exercise to try and spur growth at this point in time? Or do you believe that the emphasis is going to have to be on monetary policy to be able to do that?
Well, just very quickly, your previous question, if the monetary policy is ineffective, why do we spend so much time on it either way? So I really do not understand this argument about ineffectiveness of monetary policy. If I remember from my calculations during the time I was CA, the effect used to be between 40 and 60%. I don't see it very significantly different, the pass-through effect. So I think it's all a red herring. I'm sorry to speak so strongly. This whole issue of transmission, if you don't want to do anything, if transmission is really that bad, why are we talking about tightening? It's ineffective, isn't it ineffective? So anyway, having said that, what can the government do? Well, the government will continue doing what it is, and the only real lever we have here is something we've been talking about, but probably worth repeating, is to shift the focus of fiscal policy from consumption to investment, which is basically infrastructure investment. But as we discussed, you have discussed, everybody has discussed,
that's already been
to speed up the infrastructure processes.
Yeah.
But they are now at a position where they can do it, I think.
So let me end then by asking you, Mr. Virmani, given where we are today with IIP at a 15-month low, gross fixed capital formation also worryingly at a decade low, what would concern you the most, and what is it that you believe should be the need of the hour, should be prioritized today?
So priority is investment. So, as far as corporate investment is concerned, one factor, which was our earlier point about transmission or effect of interest rates, I don't believe that interest rates are ineffective. The NPA problem has not worsened. In fact, it's come out in the open, and therefore the risk from it should be reduced, not increased. So, these points about risk are thrown in the air, but when you're talking about a sequence of changes and a sequence of effects, you have to see when it happened. Now, this NPA problem happened 5 years ago. Over the last 3 years or so, it's been brought out in the open and made transparent, and we are starting the process of addressing it, those 12 companies, whatever, very slow, but it's not as if the problem has worsened so that the risk is higher, and therefore the real interest rate, risk-free rate is higher, or the other way around, minus the risk. So the timing has to be very carefully analyzed, and I think the issue is what has worsened. It hasn't. What has become worsened is the output, which you just pointed out, 1.7%. It's still stuck there at 0 to 2%. What is better is the inflation, and that calls for certain monetary actions. And so I just do not buy these arguments which are put out repeatedly.
Okay, so in agreement there with Dr. Shankar Acharya that monetary policy will need to be the focus, and the role of monetary policy perhaps at this point in time is greatest to try and spur the investment climate. Let me end then, Dr. Shankar Acharya, by asking you, because you were heading that committee that was set up to analyze the possibility of changing the financial year, sir. Given the fact that we've seen a lot of adjustment, demonetization, and now we're going through the process of adjusting to the goods and services tax, I know that there is a there are different camps within North Block, some that believe we should make the change to a new financial year, and the other who believe that perhaps it's too much at this point, given the kind of massive transition we're already in the midst of. If the government were to be in a position to take that call, what would you advise?
Well, as a committee, and I should say as an erstwhile committee, because we ceased to exist at the end of December, we had given in our report last December, as you know, it's with the government. And I wish that they would put it out in the public domain, whatever we've written and recommended, so that it can be debated, and then a reasoned decision can be taken. But certainly on your point that if as a result of all that, including the decision making that follows, you get another transition at this point in time, it'll make things difficult.
Okay, that's the view there, that perhaps we're in the midst of too many adjustments anyway, so another one is not the need of the hour. Arvind Virmani and Dr. Shankar Acharya, always a pleasure speaking with you. Thank you so much for joining us here on CNBC TV 18 to discuss the state of the economy. Thanks very much for your time. We are going to take a break, but there's a lot more that will continue here on CNBC TV 18. Stay right there.